Something very important just happened in the United States, and most people still don't fully understand what it really means for their money, their jobs, their loans, and their future. Today, the U.S. Federal Reserve made a decision that directly affects inflation, interest rates, the stock market, and the overall economy. Some people think this decision is calm and normal, while others believe it is a warning sign. But the truth is, this decision tells us a deeper story about where the U.S. economy is heading next. And if you live in the U.S., invest in U.S. markets, or even just follow global economic trends, this is something you cannot ignore. Stay with me, because by the end of this video, you will clearly understand what the Fed did today, why it did it, and what could happen next. Welcome back to the U.S. Report, where we break down the biggest economic and financial stories in a simple and honest way. Today's update is all about the Federal Reserve and its latest interest rate decision, and why this moment matters more than many headlines are telling you. Before we go deeper, if you find this kind of clear and real economic breakdown helpful, make sure to like this video and subscribe to the U.S. Report. It really helps the channel grow, and it ensures you don't miss future updates that directly affect your money and your life. Now let's get straight into it. Today, the U.S. Federal Reserve decided to keep interest rates unchanged. That means no rate hike and no rate cut. On the surface, this may sound boring or uneventful. But in reality, this pause is one of the most important signals we've seen so far in 2026. The Fed is basically saying, we're not fully comfortable yet. Inflation is still not where they want it to be, and the economy is not weak enough to justify further cuts. This decision reflects caution, uncertainty, and a wait-and-see approach. To understand why this matters, we need to step back for a moment. Over the past few years, the U.S. economy has gone through extreme ups and downs. Inflation surged to levels not seen in decades. The Fed responded aggressively by raising interest rates to slow things down. Then, as inflation started to cool and growth showed signs of slowing, the Fed began cutting rates. But now, in this moment, they have chosen to stop and pause. This pause tells us something very important. The Fed believes the economy is still strong enough to handle current rates, but inflation is still dangerous enough to stop them from cutting further. This is a very delicate balance. If they cut rates too early, inflation could rise again. If they keep rates too high for too long, they risk slowing the economy too much and hurting jobs. In their statement, the Fed made it clear that inflation remains above their target. Even though prices are not rising as fast as before, they are still rising faster than what the Fed considers healthy. At the same time, the labor market is stable. Jobs are still being created, unemployment remains relatively low, and wages are holding up. This combination gives the Fed no urgent reason to act. But here's where it gets interesting. While the data looks stable, confidence is not as strong as it used to be. Consumer confidence has been falling. Many Americans feel that life is still too expensive. Rent, groceries, insurance, and everyday costs remain high. Even if inflation numbers look better on paper, people don't feel relief yet, and the Fed knows this. The market reaction today was calm but cautious. Stocks didn't crash, but they didn't explode upward either. Investors were expecting this pause, so there was no shock. The dollar remained steady, and bond yields moved slightly. This tells us that markets are now focused on what comes next, not what just happened. What everyone is really listening for now are the signals. The tone of the Fed's statement, the words chosen, and the message behind them. The Fed did not promise rate cuts soon. They did not signal urgency. Instead, they emphasized data. This means future decisions will depend heavily on upcoming inflation reports, job numbers, and economic growth data. Jerome Powell, the Fed chair, is central to this moment. His press conference and comments often shape market expectations more than the decision itself. When Powell speaks carefully and avoids strong promises, it usually means uncertainty remains. And today's tone was exactly that. Careful, cautious, and controlled. For everyday Americans, this decision has real effects. If you're thinking about buying a home, mortgage rates are unlikely to drop quickly. If you have credit card debt or personal loans, interest costs may stay high for longer. For savers, returns remain stable but not improving. And for workers, job stability continues for now, but any future slowdown could change that picture. Businesses are also watching closely. High borrowing costs make companies cautious about expanding, hiring, and investing. Small businesses, in particular, feel this pressure more than large corporations. A prolonged period of high rates can slowly reduce economic momentum, even if it doesn't cause an immediate recession. So the big question is, what happens next? There are three possible paths. The first is that inflation continues to cool slowly, allowing the Fed to cut rates later this year. The second is that inflation stays stubborn, forcing the Fed to hold rates steady for much longer. The third, less likely but still possible, is that inflation rises again, pushing the Fed to consider rate hikes once more. Right now, the Fed is betting on patience. They want more proof. They want consistency in the data. and they want to avoid repeating past mistakes. History has taught central banks that acting too soon can be more dangerous than waiting a little longer. This is why today's decision is not boring at all. It is a moment of tension, a pause before the next move. And when the next move comes, it will likely have a big impact on markets, confidence, and daily life. Here at the US Report, our goal is not just to report what happened, but to explain what it really means. And what today means is simple but powerful. The US economy is not in crisis, but it is not fully safe either. It is in a fragile balance, and the Fed is walking a very thin line. As we move deeper into 2026, every inflation report and every jobs update will matter more than ever. Markets will react faster, headlines will become louder, and emotions will run higher. That's why staying informed and understanding the bigger picture is so important. If you've watched this far, you already care about understanding what's really happening, and I'd love to hear your thoughts. Do you think the Fed made the right decision today? Should they have cut rates, or is holding steady the smarter move? Let us know in the comments. Your opinion matters, and reading your comments helps shape future videos. If you found this breakdown helpful, don't forget to share this video with someone who wants to understand the US economy without the confusion and noise. Sharing helps spread real information, and it supports the work we do here at the US Report. Thank you for watching. Stay informed, stay curious, and I'll see you in the next update.